Happy New Year and welcome to Crypto Simulation Theory. I am the Gaussian Snake. This is not financial advice. Today I'm going to talk to you about Bitcoin in the larger scale of the macroeconomics, right? So looking at things like unemployment, inflation, to try to frame a discussion for how this crypto cycle may behave very differently than past ones. In fact, I think it's safer to assume that it will than assume that it's going to just be like the other ones. Because one of the things is that we've never experienced Bitcoin in a high interest rate environment during a bull run. And we don't really know exactly how that's going to affect the development of price action. We also haven't experienced Bitcoin in the six figures before. It's a lot of market cap to move around. And to just assume that we're necessarily going to see a blow off top this year might be a little bit foolish. So we need to be open to different possibilities. And I want to kind of walk you through some thinking that I have about Bitcoin. And it's going to be a journey through the stock market, through some different macroeconomic metrics, and finally Bitcoin itself, where we look at the chart. I'll start off with the chart just to kind of see where we're at this week. So you can see that I think these are Heikin Ashi candles, right? So we're currently at 97,000, roughly speaking. As far as the weekly Heikin Ashi candles, after a series of many green ones and a green indecisive, we now have some red candles with undershadows, larger undershadows and overshadows, which generally indicates that the trend is down until proven otherwise. Still have my red zone target between 84,500, 88,500. You know, I'm not like dead set on these targets, but I have reasons behind why I think those are likely targets that could be hit. Just looking at it from a very simple perspective, throwing some moving averages on here, moving average ribbon. We have a golden cross of the 50-week and 100-week, the 50s in blue, 100 week is in white. That happened in December 16th. The golden cross is playing out. So we can see I did talk about this in a previous video that once the 50-week enters into this red zone, which I think should happen fairly soon, that could be a stopping point for the downtrend before we see a reversal into an uptrend into February, which is kind of my base case for now. But let's go take a much like a bird's eye view of Bitcoin in the greater context of the stock market and just the broader markets in general, look at global liquidity, things like that. So we can kind of frame our discussion of what might be different about this year than previous bull market years like 2021, 2017, and 2013. So this is the S&P 500 on the weekly time frame. It's really not looking so great. These are Heikin Ashi candles. After some indecisives, we now have a Heikin Ashi candle with an undershadow indicating further downtrend is likely. The 200-week HMA looms at around 5,600. So I would probably look to that as being an area of potential support. It could also mark a change. There could be a change in trend for the S&P. We don't know yet exactly what's happening here, just that it's not opening up in a very nice way in the new year. If we flip on quarterly Heikin Ashi candles and look at the quarterlies, the picture is not as concerning. We still have a green Heikin Ashi candle. We are still above the 60-week HMA. This is the 150-week HMA. I'm sorry, I'm saying weeks. This is the 60-month HMA. This is the 150-month HMA. And then way down here would be the 300-month HMA. So these are some pretty long time frames that have been respected now for quite a few quarters. Seeing this, we certainly like to see the S&P go higher this quarter to give us strength, to give us an confidence about having market strength heading in to the second half of this year, right? Like we just started this year off, but this is just not a great way to be opening. But the quarter is new. Quarter four Heikin Ashi candle closed very strongly. This is a beautiful series of quarters for the S&P. So this is just, something to keep an eye on. I mean, I wouldn't get overly concerned just because, the quarter just started like a couple days ago. It's really not anything to get too reactive to, but it's just something to pay attention to. We don't want to see an indecisive green Heikin Ashi. That is kind of risky, and it does, that could potentially spell some trouble in the markets. This right now, though, is nothing to be overly concerned about. Unsurprisingly, Bitcoin's Heikin Ashi candle for the quarter also looks fairly good. We have to see if we can maintain this candle or if it comes down, which I think it's probably going to do, just following the S&P. One thing I'd like to look at, is just the correlation between the S&P and Bitcoin. Sometimes these assets are pretty heavily correlated. Sometimes they're not. So we'll go ahead and run a correlation study and see what things are looking like. Do that with S&P. Go ahead and apply that. Ignore the other graph. So Bitcoin is fairly positively correlated with the S&P at this time, although that correlation is decreasing because Bitcoin has been relatively stable while the stock market has not. We are seeing 77.6% correlation. So it means that whatever the S&P does, Bitcoin is likely to follow. That's not really happening right now. Hence, the metric is starting to drop, but I think this will probably come back up again soon. I apologize for this messy chart, but this is a chart that is concerning to me a little bit. So this is U.S. unemployment level. This is should be on a monthly time frame. I don't know why it's saying weekly. That's not true. Monthly time frame. And so this light green, thing that went crazy in 2020, it kind of has come back to normal. So you can almost imagine like a bull that's kind of existed from late 2019. It's finally caught up now. Unemployment is clearly trending up. Like there's no question about it. In fact, the 20-month whole moving average golden crossed the 100, and the 50-month also golden crossed the 100 and is about to golden cross the 200. This is not really what you want to see, especially as we're, theoretically in the 2025, bull market year. This is not good. So, in terms of where the moving averages are at, especially. So I do look at that and kind of wonder, okay, unemployment right now, this is the unemployment level. Let's look at the unemployment rate. What I would, it's going to look pretty much the same, right? But the chart doesn't change that much. So the unemployment rate, right, it looks pretty much the same. I mean, there's not a lot different about it. Okay. But this is what I wanted to talk about. Unemployment rate is at 4.2% and clearly in an uptrend. What can the economy handle? And I think that's a really good question. And how is unemployment even being measured? Another good question. But this is typically not what you want to see in a bull market year. You don't want to see unemployment trending up. You'd prefer to see it trending down. And during most of Bitcoin's existence, that's what's happened. This is different. This is something different than what's happened in the past. If we slap on a Gaussian channel and a weighted logarithmic Bollinger Band, and I'm going to turn off the HMAs, well, what do we see happening? Let's see, where's my Bollinger Band? We just see not good things happening, right? So here's a red Gaussian channel on the monthly. It seems that unemployment has finally gotten above the upper line of the channel, and it is like very close into entering into the red channel. Now, the big question is when we hit, like, let's say if we hit like 4.7% unemployment, does something happen to send it back down? Or do we just keep going up? I don't really know what's going to happen. It looks like the Gaussian channel may be inflecting here, suggesting that an increase in unemployment rate in Q1 of this year could be likely. That is not going to be good for our bull run if that happens. And so this is just something that to me is like essential to keep an eye on. This is the United States M2 money supply, or just a measure of liquidity in the system. And you can see that for the first time ever in history, there was a really nasty drop below the 200-month whole moving average. Money supply did then come back above the 20-month, which golden crossed above the 50-month. So, but look at the 100-month kind of coming down. So there's a big question. Obviously, we are in a period of very slow monetary expansion. The Federal Reserve has lowered interest rates in the second half of last year, but they haven't really been super aggressive about it. I mean, they did make a pretty nice cut in the beginning. It was like 50 basis points, and then it's been 25 ever since. So the question is, what are they going to do this year? I don't even think they know what they're going to do. We'll look at CME group forecasts in a little bit, but I don't know what's going to happen. Let's say the money supply keeps printing, which we know the Federal Reserve is they're gonna print money. There's probably going to be some kind of QE in the first half of the year. I think. but what does concern me is the overhead 200-month HMA. What's going to happen when we get to like $22 trillion? Are we going to hit resistance here and start to head back down? What would that mean if that happened? That would mean inflation would be a problem. Inflation would come roaring back. So I think it's prudent for us to go ahead and take a look at inflation and see what's going on over there and if it's an immediate threat or maybe a longer term threat. Well, the Fed's done their job. I mean, inflation looks really I want to say terrible, but I mean it in a good way. The alligator is upside down on the alligator indicator. Inflation is it's just under control at the moment. You might say, well, it did tick up, but I don't think this is necessarily going to be sustained. I mean, the trend is your friend till the end. I think that inflation is pretty well under control. That is good news. That's good news for, at least part of this bull run. But the question is, what happens when the inflation rate gets a little bit lower? If it gets lower, let's say, this of course is monthly data. Let's say that, December reading comes in maybe slightly elevated, but then we start to roll over maybe in the first quarter of this year or second quarter. I mean, that's a good thing to see inflation coming down. And honestly, that is the most likely direction for it to go based on this trend. I mean, of course, we don't know. I mean, some sectors are more inflated than others. We did have a little bit of a resurgence. But what does concern me is that let me turn off some of the noise here. Okay, let's turn the alligator off. I think I can leave the Gaussian channel on. What do you notice is happening with the Bollinger Bands? I'm noticing a little bit of compression. That does concern me. That means that a bottom for inflation is probably coming fairly soon. And I think that the market will react very favorably to that. Let me be clear. I think the market is going to like inflation coming back down to these lower levels. But seeing that the Bollinger Bands are compressing does mean that there is very little variability at this point compared to earlier, right? When we had some pretty wild swings up or down. If we go through history, these Bollinger Bands have been all over the place, right? So I can't say for certain what's going to happen here, but I know 2% is kind of that's around the Fed fund rate target. And, interest rates are fairly elevated right now. We're going to flip those on too, so you can kind of see what's been going on with those. So I don't know how much further down that they're necessarily going to come because they've got inflation kind of almost right where they want it. And it really wouldn't make a whole lot of sense to start printing money like crazy because that's just going to cause inflation to come roaring back. So it kind of sucks. You have the inflation rate down near the levels that the Federal Reserve wants them to be, but then you also have to keep in mind that interest rates are still fairly elevated while this is happening. So I feel like the Fed is still stuck between a rock and a hard place, and I think this is a game they're ultimately going to lose. And I do think inflation will come back. I don't think it's going to come back in half one of this year. I think it's kind of unlikely, but I would be looking to half two for potentially another resurgence of inflation. I don't think it will be as bad as it was the first time around during COVID, but it could be a pretty significant bounce, and that's something we should keep in mind. So the question is, can the production of goods and services, basically the productivity of the United States, keep up with inflation? And so we have the real gross domestic product, or RGDP, that takes that information into account. Now, the trend right now for GDP has been up, but it hasn't not been up like aggressively. If you look back into the 90s, look at how GDP, especially during the second half of the 90s, was going up in a very aggressive kind of way. Now, that could happen. It is possible, but it just depends on the overall health of our market. How, are we able to, it's simple. Like, can we make enough productivity in the United States, worker productivity, goods and services productivity, to keep up with the inflated money supply? At some point, the system is going to collapse on itself. There's a finite number of resources to produce things, and there's an seemingly infinite amount of money that you can print and dilute the value of those. So we'll have to kind of see what happens. The last reading on this was quite GDP is showing July of 2024, at least on this chart. I'd probably have to source the actual data. This comes from the Bureau of Economic Analysis. So this is not This is a fairly old chart at this point, so I don't know why it's missing some data, but hopefully this gets updated and we can get like a better idea of what GDP actually looks like. We could take GDP and divide it by USM2, and we could see kind of like how that looks. All right, these are Heikin Ashi candles. Not sure if are these Heikin Ashis? Let me check. Yeah, they are. Let's put on regular candles. So this is kind of interesting. So this is GDP, which is not adjusted for inflation, divided by the money supply. And it's just kind of been all over the place, right? You can kind of clearly see the bear markets in here. And this was not a bear market for crypto, but productivity was going down, came back up in April of this year. And it's kind of like, it looks like something big's about to happen, right? Is this going to explode to the upside, or is it going to take another leg down? That is the $1 million question that we don't know the answer to. But it's been kind of going sideways for quite some time, meaning that, what does that mean? That quite simply means that as money supply has been increasing, productivity has been going down. Okay, or goods and services, value of them has been going down more or less during certain periods, but really it's just been kind of sideways, right? So in the past like 10 years, in the past decade, we have not really seen innovation in the United States on the scale that we did in the late 90s. I think we're starting to see that now with the AI boom, but who knows where that's going to go. So this is, again, something to kind of keep in mind as we move forward. And hopefully we can get some more data on the real GDP. Okay, so this is the S&P overlaid with the federal funds rate, which is clearly in a downtrend. The S&P is, experiencing a little bit of trouble at the beginning of the year. Again, nothing to worry about just yet. But the question is, how deep will this correction go? And does it have legs to it? So we should probably take a look at the CME Group forecast. We know that when the federal funds rate starts dropping aggressively, the market can react in different ways. But if we're getting close to what's perceived as a rate cut floor, there could be a reason for that. Aggressive cutting, there's like a reason for it, right? And then you can see that reflected in the market if the market starts tanking. Now, I don't know that it's necessarily going to do that, but let's go ahead and take a look at the CME Group forecast and where they're at right now on January 2nd. We know we have an FOMC meeting coming up near the end of January. I think it's like January 29th or somewhere around there. So, what does it say? Okay, so there's about an 88% chance come the end of January. So yeah, January 29th, that the Fed's just going to hold rates steady, not cut. March is very split, but that's kind of what we're looking at now. So if we look toward the probabilities chart, and I can zoom in on this for you, especially if you're viewing this on your phone, it might be hard to see. Okay, sorry for the banner there, but so you can see that the market is kind of like uncertain about March, fairly certain that we're going to hold steady in January. But this is where it starts to get really interesting, because they're only pricing in 2 cuts this year. I think maybe inflation is part of the reason for that. I'm not really sure. I'm not sure I really understand the logic behind this ever, because it changes so frequently. I wouldn't take what you're seeing in half 2 of the year too seriously yet, but just the fact that the market is prepared for rates to hold fairly steady. And I mean, like, this is like still 375 to 400 basis points. That's got to be affecting the economy. This to me is not like much in the way of quantitative easing. And I know there's other ways for the Fed to free up money supply, but I mean, this is not very aggressive. Now, and you could look at that in a good way and say, well, hey, that means maybe the economy looks pretty good. And in a lot of ways it does. Right? Other than unemployment kind of trending upwards, unemployment has not been trending upwards aggressively. Inflation's been trending down, which is good. So, I mean, this is kind of saying like, we think the economy is pretty good right now. That's what I'm seeing from this. Now, where this gets concerning is if the Fed has to pivot at some point this year, whether that's pivot maybe in half 2, if inflation starts to go back up and they've got to raise rates, Or maybe the economy starts to go south, unemployment goes up, and they feel the need to cut. Either way, seeing this data makes me a little bit uneasy. Okay. It makes me feel like we could be in for some surprises this year in the market. And yeah, I mean, not that I would want to see aggressive cutting. That also is not a good thing. But I just don't trust this chart right now. I think, let's see what this looks like closer to the end of the month. But there's just a lot of uncertainty right now about the market, and I think we're waiting to hear from the Fed. And I think as the quarter goes on, we'll see these numbers start to update. I don't like to focus too much on the macro because I feel like you can easily get lost in the noise trying to make predictions about recessions and things like that. I have no idea when the next recession is going to hit. I just know one is going to hit because um, we're in a boom and bust economy, and whatever goes up must come down. And we also know that we just went through one of the most aggressive rate hiking cycles in history not that long ago. The effects are certainly starting to be felt, but maybe there's still more to go. So if we go to the Bitcoin chart on the weekly, and now I'm just going to look at it from a pure TA standpoint and give you kind of a TA update on Bitcoin. Turn the Heiken Ashi candles off. We have traditional candles on. We are dumping, into our 50-week moving average. That appears to be what's happening. There's a little bit of a head and shoulders formation as well. Even though the candle right now for this week is green, it's not impressively green, and we can see the 20-week is starting to roll over. So I do expect a period of weakness in the market for at least the first few weeks of January. However, I feel once we get into this red zone, okay, I'm going to really zoom in on it. It's such a small red zone, but I have a red zone between 84 and a half and 88 and a half thousand dollars that I think could mark kind of where the 50 finally makes its way inside by the time this comes down. I'd imagine in a couple of weeks. And I think that that's a likely situation to happen. And I'm going to give you some under the hood explanations why. So this is the weekly wave trend indicator. It printed a bearish divergence on December 23rd, and it's going down right now. So I think we need further downside probably, but how much further downside is anybody's guess, right? We could come down to the bottom like we did in January and then have another run up, right? The wave trend by itself is not, going to tell us exactly when it's going to reverse back to bullish. Um, usually speaking though, when we get into mania, we actually get above the red zone, and we have yet to do that this cycle at all. So I don't anticipate that the wave trend is going to come down like really low. We already kind of did that, but I think it's going to put in some kind of low, macro higher low relative to this one here before it takes back off again. And it could be on that next run that we actually get above the red zone. So I am still bullish on quarter one. My viewpoint has not changed for quarter one based on what I'm seeing here. Something else that's kind of interesting is that the weekly RCMO got pretty hot in December. It got all the way up to 85. Earlier in the year, it got up to around 75, and it got even all the way up to 90 in November of 2023. These are some pretty high levels. And what we see right now is potentially a failure to get higher. The signal line is still green, but it is kind of concave down. Could we potentially see a little bit of red heading into February? Like I said, I still think quarter one will be remembered as a bullish quarter, but that doesn't mean we're not going to have some trouble first. You can see that we don't often hit these levels that are super high, although there was an exceptional period in 2017 where we did. So could we be looking at something like an extended 2017? We certainly could. It is possible, but we should understand that 2017 did not occur in a high interest rate environment with rising unemployment. So this is just something to look at. If I throw on the 2-week reverse Chandy momentum oscillator, RCMO, we can see, we talked about on this channel how I was calling for a top around the time that we got to like this reading in February and March, said the top for Bitcoin is likely very close to being in a significant top. It's exactly what happened. We actually put in a slightly lower low on the RCMO, and now we're coming up, and this bounce is kind of nice on the 2-week, right? So I think this has a decent chance of ending up kind of in a higher zone sometime. Could be later this quarter. It's a pretty strong bottoming formation, but I don't think we're going to get all the way up to a score of like 100. That is a very unusual score to get on the 2-week. Doesn't happen too often. So, but I still think there'll be some upside. It's just the question. So yeah, I mean, I think Bitcoin, like on the whole, still looks pretty bullish. Like if we look at the weighted logarithmic Bollinger Bands, we can see that we are in a breakout on the 2-week. I'm going to turn off the moving averages. We are in a breakout. We're just coming down from the top line. We've seen stuff like this before, right? You ride these Bollinger Bands, you come away from it, and you come back up, come away from it. Sometimes you hit the median line, sometimes you don't. I think this will probably be one of those cases where maybe we don't hit the median line. And again, I'm looking for a continue to the breakout. If you look at the Gaussian channel, it is still very bullish looking, okay? So I still think we're in a bull market until proven otherwise. Now, what I don't know what I'm not sure of is if we're about to enter into like a giant mania phase. This is where all of the market dynamics kind of come into play and make me sort of scratch my head. And I'll explain what I mean by that. So one situation I'm watching as I turn on the fibs and the ADX and DI, now I'm fairly confident in Q1 sometime we're probably going to take out this 1.272 fib and start to move towards the 1.414. The area of concern for me is right now somewhere in between the 1.414 and 1.618 fib. Not just from like a superstitious standpoint, because the 1.618, like the 618, often has a lot of touch points, but that price level of 173,000 is fairly significant. If we, I'll talk about the ADX and DI in a minute, but if we turn on like the risk metric for Bitcoin on my indicators, so this is the Pan XBT risk metric, we can see that if we get near the 1.618 fib, it's possible that we are at the end of this bull cycle. And how far away are we from that right now? So a lot is going to depend on how fast price accelerates, let's say out of the red zone. Let's suppose that price were to enter the red zone, let's say January is a red month, and then we get into February and we build out a nice base here, and then we rise all the way up to like close to the 1.618. That's almost a 2x move, and I think it could happen. Okay, I think it is possible to happen. Bitcoin's risk right now is only at 60. So the question is, what happens next? Do we stop out at the 1.414? Or do we potentially have some kind of mania move up to the 1.618 fib, potentially Q1, Q2 of this year? What would happen if that occurred? And that's something I think we need to consider, and to the credit of, sorry, let me just get back in here and turn that off, turn the risk metric off. To the credit of the ADX and DI indicator, what I see happening now on the 2-week is we have a trend strength of 21.57, which indicates a building trend strength. Okay, we bottomed out just under 20. You can see right now that the bullish trend strength is kind of pulling back. I expect this to go back up at some point in Q1, and I think trend strength will follow. So this gets a little bit scary if trend strength starts to take off in Q1. And we actually slice through the 1.414. This is something I'm open-minded to happening that could potentially cause a disruption to this cycle in the middle of the year. What makes it really tricky too is, okay, does that just throw us right into a bear market? I don't think it throws us right into a bear market, but it could make the market very tricky to navigate. What would be ideal is if price action would kind of hang out at the 1.414 fib. And I am open to that possibility as well. Like if we were to pull back here and then go up to the 1.414 and just range, maybe range a little bit here and have an altcoin season, and then later in the year come up to maybe the 1.786 or something like that, for a cycle top. So I really don't know what's going to happen, but I will say that we can see on the 2 weeks in buildings trend strength, and you don't see these bottoming processes happen very often, right? So like last happened in 2023. Before that was in 2022. Before that was in 2020. And before that was 2018. So after you get this bottoming process, you do get some kind of up leg. Are we going to see trend strength at levels of 60 or higher? Are we going to see a higher high for trend strength? We don't know. If that were to happen, maybe we even blow off past the 1.618. So my point is, I think it's possible we get a blow off top this year. I do. Certainly the technicals are setting up for that, but we need to keep an eye on the macro as well. We need to keep an eye on unemployment. We need to keep an eye on inflation, interest rates, all of that. And also keep in mind that our top may not be as exciting as we think it could be. Perhaps the top is somewhere between the 1.414 and 1.618, and we don't make it all the way to the top of the risk, right? To the 100% risk, because of the fact that the federal funds rate is kind of elevated and maybe liquidity isn't flowing as freely as it has in the past. Liquidity has always been flowing very freely throughout Bitcoin's history. This is the first time where it isn't. So I just kind of take all that into consideration. And, you know, what's kind of the bottom line with all this discussion about potential price action for Bitcoin is that don't let any good bubble go to waste. 2024 was undoubtedly a Bitcoin year. I don't think that this year is going to be a Bitcoin year. It's certainly starting out as one, but look at Bitcoin dominance. Bitcoin dominance on the 2-week is clearly riding the median line of its weighted logarithmic Bollinger Band for the first time really since early 2024, right? Ironically, exactly a year ago, but it looks weaker than ever. Like we had what looks to me like a pretty clear top at around, you know, just under around 62% dominance. I'm satisfied with that being a top. I think it very well could be. Bollinger Bands are starting to flatten out. Gaussian channel still is concave up and tight, but it looks like Bitcoin dominance is ready to drop out in, you know, and how that's going to occur, I don't know, right? I don't know if that's going to occur on a Bitcoin dump or pump. I think more likely on a pump than a dump. But, you know, and by the way, we broke out of this. I don't even know why I still have these lines here. But yeah, if we're looking at Bitcoin on the 2-week right now, gosh, what is all this? I don't know if I just pulled up the wrong chart. Yeah, I don't know what I'm looking at here. I think I pulled up the wrong chart, like Bitstamp or something. Yeah, I pulled up Bitstamp. Let me go to the index. Sorry, guys. Bear with me. Yeah, there we go. I was like, I don't know what I'm looking at there. So yeah, if we look at Bitcoin, I mean, I think we do need to start kind of paying attention to topping indicators. Not right now, but as we progress through Q1 and beyond. So just to give you an example of what some of those, you know, could be, let me turn off some of these indicators. Turn off the weighted logarithmic Bollinger Band. And I'm actually going to keep the fibs on. Let's go throw on the pi cycle top Bitcoin indicator. So see, I think it's, I forget which ones that I use. I think there's one of them. We have not had a pi cycle top trigger. Well, it actually, I should put on the weekly. So on the weekly, we have not had a pi cycle top trigger since April of 2021. Okay. And this is the 111-day moving average and the 365 by 2. What we're waiting for is for the 365 by 2 to golden cross. And I think these fibs are kind of are more distracting than I thought they would be. Let's turn them off. What we're waiting for is for a golden cross of the 111 with the 365 by 2. And I think that's likely to come this year. And I think we're likely to print a pi cycle top in Q1 or potentially Q2, half one of this year, we'll just say. And we really got to watch out for what the market could bring us. Could we fall into a recession? We could. I don't know if that's super likely to happen this year, but it could happen. You know, I'd like to see this Gaussian channel, some of this data from this uptrend start to make its way into the Gaussian channel and see this start to curl back up again. I don't like that it's concave down right now. But I think, you know, you can imagine a golden cross occurring in February, sometime in Q1, especially as some of this upward data starts to build its way in. And that's when you're looking at a pi cycle top being very nearby when something like that happens. And so will that occur at around 150,000, 170,000, or 200,000? I don't know. Nobody knows. But like if we look at the stochastic oscillator right now on Bitcoin, you know, clearly it's had a nice pullback, but we're in a zone where we could either fall just a little bit further, which would probably put us in our red zone, or we could start to work our way back up. we usually, when you get into the hot zone in the stochastic oscillator, which we're no longer in, by the way, we're in the upper echelon of it, you're going to spend some time up here. So I expect us to get back into the hot zone, in certainly mid to late quarter one, possibly even in the quarter two. But I think the market's in for a period of weakness sometime in the middle of the year. What I don't know if that's if that's going to be the introduction to a bear market or just a prolonged cool off, and something to be open-minded to. If that happens, and this is kind of the point behind showing you all this economic data earlier, is that we could be tricked out into thinking we're in a bear market when we might not actually be in one. And the market could surprise us all by roaring back at the very end of the year or even in 2026. Okay. So we're in a complicated environment. And I think the best thing you can do in this situation is have a plan and stick to it. Have a buy strategy and a sell strategy. And remember to not let any good bubble go to waste. Take profits when you're up, because you don't know when that's going to come back around again, whether that's with Bitcoin or with something else. So, I wish I could predict the future. I wish I could tell you exactly what was going to happen. No matter how many charts and indicators I look at, it's impossible to do that. It is, I mean, it's definitely looking like we're going to have a fairly bullish first quarter, but beyond that, who knows? These are the monthly candles for Bitcoin, by the way. And, I'm not really enjoying the way this looks at the moment, but it's nothing like, if we look at moving averages in terms of monthly, there's really nothing to be like that concerned about, right? We're above the 20 month, we're above the 50 month, which is golden crossed with the 100 month. Those are some pretty strong moving averages. So look at where the 20 month is entering in. It's entering into the red zone. So, despite the fact that this formation is not something that looks like super great, I think, again, it's going to be just fine. We're going to rocket back off to one of those higher fib levels, somewhere between, on the low end, I'd say 132,000 to the high end around 200K, just depending on whether we rocket off to a new all-time high or not. Yeah, I think that'll be about it for now. So, I'm still bullish for Bitcoin for this year, but I am open-minded to the idea of a mid-year slowdown, or even an end-of-year slowdown, or as we get into quarter three or late quarter two, or somewhere in the middle. I'm anticipating there will be some kind of slowdown, and it could be a lot worse than what we had here, especially if we start to exhaust some of the upside potential of Bitcoin. Okay, so those are my thoughts. And if you have any questions, let me know in the comments down below. Be sure to like the video if you enjoyed the content. Subscribe to my channel if you like this kind of deep dive data analysis. So I think what we're in right now is the dump before the pump. It's not unusual at all for Bitcoin to dump into a golden cross or around a golden cross and then pump afterwards. Just like we predicted that we would pump into the death cross and we called that a pump and dump. Well, we could be in the dump part where we come back down at the moment, and it just so happens to be into a fairly aggressive golden cross. So let's not also forget that we have the cup and handle formation, which is very bullish. So it doesn't make any sense to be bearish right now. If you're short-term bearish, that's okay, I think, but it doesn't make sense to be bearish. I think it still makes sense to be bullish. And I think we're going to have a really good new year. I think, February especially, I am expecting to be a pretty aggressive green month. March could be as well. I know March traditionally is not a good month for crypto, but I think we need to move away from, month narratives, right? Talking about what certain months do and how that goes. So I think overall, I think it makes sense to be bullish. Also, I would encourage you to join my Telegram channel. It's completely free, and we do daily market updates. We talk about altcoins, new altcoins, hot altcoins, and we give more signals than most paid groups give. So you get all that for free just by joining the Telegram channel. I also have a Twitter, TikTok, and Instagram, so be sure to check those out too. Remember, nothing in this video should be considered financial advice. Always do your own research and get your own perspective on the market and act according to that. Till next time, bye-bye.